Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. One of the significant recent activities here had been the late August break higher above the July to August upper bear channel line. In the process of moving higher, prices formed an ascending wedge pattern. This pattern is highlighted in blue on my daily chart. This carried on higher until in late September, when the market's rise met a resistance that it could not overcome, despite trying for 4 weeks. This was the important slowly rising long moving average, currently at 946, which at times coincided with the November 2012 high at 930. This moving average was breached, but did not have 2 consecutive closes over it at any point in its testing. 4 weeks ago, at the high water peak of the market, prices turned down with a very interesting weekly key reversal down, heading lower through the lower trend line of the ascending wedge pattern. The market dropped below some significant supports. And it was only 3 weeks ago at the slowly rising short medium moving average, currently at 872, that we found the beginnings of some support. 2 weeks ago, I laid out what I thought might be the possibilities here for the future, and I quote, "There are now 2 avenues that I can see for this market, though there are no doubt more avenues will be available eventually. I'll make themselves known. In the first is the straightforward move down with potential targets for the ascending wedge pattern. Thus, a primary target X on the downside has already been achieved in the 860 area, whilst a secondary harder to reach target X1 is way down below in the 712 area. This leads to the second avenue, something that I had previously mentioned on a number of occasions. It is the possibility for the whole of the July to date action being not just a V bottom, but a V bottom with an extension. These extensions have something like a bull flag within them, and that is what may be being built since mid to late August. Personally, it looks a little slack as a pattern, but if the short medium moving average manages to hold the market up, which so far along with the November 2012 low A43 it sort of is, and we then eventually see prices revert back up, well, then this second scenario, the larger V bottom with an extension, suddenly looks a lot more interesting." That's the end of the quote. The early part of last week looked very much like we had the beginnings of an up leg in a possible V bottom pattern with an extension. In this case, more a slack bullish halfway hesitation rather than a bull flag. But the reversion back down midweek countered that move. This week, the medium moving average, currently 849, has started really pressuring the market lower, below the November 2012 low at 843 and into the congestion from July and August this year between about 775 to 840. Thus, the incentive, which to be honest, as I said last week, was evenly matched between congestion above and below, well, is starting moving now much more in favor of the bearish incentive. So unless prices can rally, and really soon rally, to build up a better bullish halfway hesitation, then the dominance of the break below the ascending wedge pattern will become the prime driver, and target X1 in the 712 area will really start to look good. Chicago corn. Here are some of the key elements from my comments formed over the last few weeks. This first element is the reverse head and shoulders pattern over July and early August. It has turned out to be a good one, especially the slightly optimized neckline currently at 704, which I highlighted in blue on my daily chart. This neckline had until recently been incredibly supportive since the market broke higher over it back in late August. The primary target for this reverse head and shoulders pattern has already been achieved, and I've decided to retire the secondary harder to reach target in the 714 area. Secondly is the impact of the slowly rising long moving average, currently 693. This had earlier tried to cap the market, but as it separated from the 50% Fibonacci line of the September 2021 to April 2022 move at 661, its efficacy as resistance faded, with the market moving up through it. Interestingly, last week it became both support and resistance, and this week purely resistance. Finally, the most important of all, there is the July to date ascending wedge pattern, currently 735 to 768. This is the one highlighted in red trend lines for these viewing on my daily chart. I had personally found this to be the most elegant of all the elements. 3 weeks ago, the market exited this pattern, and for a couple of weeks, it seemed the market was looking to see if there was enough bearish pressure to make itself evident and push prices lower. Well, this week, we found out there was. Thus, we now have a primary target X for the break below in the 648 zone, with a secondary harder to reach target X1 in the 550 zone. Now, I did raise a question last time as to whether there was also a possible very large V-bottom or bearish halfway hesitation pattern. I left that open at the time, but it's time now to start addressing it. So, if there is to be a V-bottom with an extension or a straightforward bullish halfway hesitation, then it needs to show itself right soon and in force. Otherwise, not only will the 648 level be in the frame, which it is already, but the 550 level will start looking very, very attractive. The things that may trigger such a move are already there. The 648 level to start with, though is more of a last resort than anything else. Before then, we have support from the 50% Fibonacci line of the September 21 to April 2022 move at 661, which is holding up the market yesterday and today, plus a little below the now flatlining medium moving average, currently at 654. And then there is the lower time, currently 644, of the September 2021 to July 2022 bullish Andrews pitchfork. Admittedly, this one is below target X at 648, but by next week at this time, it would have risen above it. So there are some interesting levels nearby and below to watch out for, and if they're going to be crushed or broken. The market this week took the opportunity to drop down through what is effectively a fairly free zone from below the short medium moving average down to the 50% Fibonacci line at 661. This coming week we'll see if there is more substance behind the fall than just falling through thin air. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. Here comes the final bit.